One of the most important responsibilities of a company's management team is capital allocation, the decision of where to invest the firm's excess money. As investors, it's our duty to make sure that the managers of the companies that we own are making good decisions with our money, as this can have a profound impact on our long-term investment returns. In this video, I'm going to give you a detailed explanation of the 5 ways that corporate managers can spend money, and I'm going to tell you how each one can impact the intrinsic value of the stock that we own. The first capital allocation option that we'll discuss is organic reinvestment. Organic reinvestment is exactly what it sounds like, reinvesting cash back into the business that generated it. Organic reinvestment is likely the most simple and straightforward form of capital allocation. The decision on whether or not to reinvest funds into the business that generated them is completely dependent on 2 factors. The first is capacity. How much capital can reasonably be invested per unit of time before diminishing returns begin to occur? The second factor is business unit profitability. This is generally measured by return on invested capital and shows the return that can be expected on any reinvested capital into the business. Ideally, a business will have high returns on invested capital and large capacities for organic reinvestment. Walmart in the 1970s is an example of this. The company could earn excellent returns by opening new stores, and there was a virtually limitless amount of new stores that could be opened. This led Walmart to be one of the best performing stocks of its time, as it rapidly expanded its geographic reach across the United States and internationally. When it comes to organic reinvestment, it's important to keep in mind that not all businesses have the choice of whether or not to organically reinvest into their business. Said another way, some businesses are forced to spend money on organic reinvestment. A quote from Charlie Munger can help us understand why. He says, "There are 2 kinds of businesses. The first earns 12% and you can take the profits out at the end of the year. The second earns 12%, but all the excess cash must be reinvested. There's never any cash." It reminds me of the guy who sells construction equipment. He looks at his used machines, taken in as customers bought new ones, and says, "There's all my profit, rusting in the yard." We hate that kind of business. Charlie's opinion on these types of capital-intensive businesses was formed after he made a bad investment in a Caterpillar tractor dealership. The key takeaway here is that organic reinvestment should have 3 characteristics in order for it to be attractive. It should have high returns on invested capital, a large capacity to take new capital, and the optionality of whether the capital needs to be reinvested or whether it can be pulled out of the business to pay dividends, repurchase shares, or spend money on other capital allocation options. The next capital allocation option that we'll discuss are mergers and acquisitions. Mergers and acquisitions are the most transformative and arguably the most risky form of capital allocation. Moreover, there is a great divide among the investment community about whether mergers and acquisitions actually build value over time. We believe that whether M&A makes sense is highly dependent on the terms of the deal in question. More specifically, good M&A should have the following characteristics: a sensible purchase price, with the lower being the better, and an acquisition that's funded through cash on the balance sheet or debt, but definitely not through shares issued. Mergers and acquisitions are complicated. Accordingly, we recommend that investors analyze M&A on a case-by-case basis for the companies they own before jumping to conclusions about whether it actually builds shareholder value over time. The next capital allocation option that we'll discuss is debt repayments. Of all of the capital allocation techniques employed by corporate managers, debt repayments have the most certainty. With that said, just because they have a lot of predictability does not mean that they're an attractive way to spend your investors' money. In fact, today's low interest rate environment means that there's almost always a better place for managers to spend their money. Accordingly, when you see a company that's aggressively paying down its low interest rate debt, this should be a red flag for you as an investor. The next capital allocation option that we'll discuss is dividend payments. Dividend payments form the center of much of what we do at Share Dividend. In fact, dividend yield is one of the ranking factors in our quantitative investing strategy, the 8 rules of dividend investing. This is because dividend-paying stocks have tended to outperform the broader stock market over time. Interestingly, the theory suggests that this should not be the case. After all, dividends are actually a tax-inefficient way of returning capital to shareholders. This is because when an investor receives a dividend, they must pay tax on that dividend immediately. The other method of returning capital to shareholders, share repurchases, does not have this problem and allows for the tax to be deferred indefinitely. Because of this, we believe that the outperformance of dividend-paying stocks is not actually due to their dividend payments. Instead, we believe it's because the payment of dividends communicates that a company is acting in the best interests of its shareholders. If a company is willing to send you a cash check every quarter, it's likely that the behind-the-scenes decisions that they're making are also in your best interests. This is a belief that's corroborated by many of the world's most successful and influential investors. For example, Benjamin Graham wrote the following in his book, The Intelligent Investor. "One of the most persuasive tests of high quality is an uninterrupted record of dividend payments going back over many years. We think that a record of continuous dividend payments for the last 20 years or more is an important plus factor in the company's quality rating. Indeed, the defensive investor might be justified in limiting his purchases to those meeting this test. We believe that the decision on whether or not to pay dividends is highly dependent on the condition of the business that's paying them. For example, Walmart in the 1970s, which we discussed previously, would have been foolish to pay a dividend because it needed that cash to open new stores. A counterexample would be Coca-Cola today. With their dominant presence in the beverage industry, we believe that it makes a great deal of sense for Coca-Cola to return cash to shareholders through dividend payments. The fifth and final capital allocation option that we'll discuss in this video is share repurchases. Share repurchases are likely the most misunderstood way that corporate managers can send cash back to their shareholders. They are also one of the most powerful if implemented properly. Share repurchases occur when a company buys back its own stock for cancellation. This reduces the number of shares outstanding and improves important per-share financial metrics like earnings per share and book value per share. Importantly, the value-enhancing capabilities of share repurchases are highly price-dependent. Buying back expensive stock destroys shareholder value. On the other hand, buying back undervalued stock is one of the best ways that corporate managers can spend their investors' money. One method to help investors understand how share repurchases can impact intrinsic value is through a simple analogy that uses a privately held business. Warren Buffett provided such an analogy in the Berkshire Hathaway 2016 annual report, where he wrote, "Consider a simple analogy. If there are 3 equal partners in a business worth $3,000 and one is bought out by the partnership for $900, each of the remaining partners realizes an immediate gain of $50. If the exiting partners paid $1,100, however, the continuing partners each suffer a loss of $50. The same math applies with corporations and their shareholders. Ergo, the question of whether a repurchase action is value enhancing or value destroying for continuing shareholders is entirely purchase price dependent. Share repurchases are complicated, but the key takeaway here is this. When a company's stock is deeply undervalued, one of the best ways that the management team can allocate capital is through an aggressive share repurchase program. Thanks for watching today's video on the 5 capital allocation techniques and how they impact intrinsic value. I invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education videos. If you're interested in learning more about our quantitative approach to dividend growth investing, I invite you to check out our website at www.suredividend.com. I'll see you there.